S&P 500 futures, the ES, are cooling off a bit this morning, trading down about 0.1%. Feels like a strategic breather.
It is. The pre-market volume tells the story. It's a cautious, almost frozen sentiment.
Right, the high-frequency traders are just parked on the sidelines, waiting.
They're waiting for 8:30 a.m. ET for that CPI print to either confirm this trajectory or, reject it violently.
And it's not just jitters, is it? You've called this a high-stakes triple header.
That's exactly what it is. It's a full-stop freeze ahead of a convergence of, three major systemic risks. A collision of macro data, micro-earnings, and policy. It's going to dictate the entire open.
Probably the most chaotic Tuesday morning we've had this quarter.
I would say so, yes.
So let's define that collision. What's the immediate data threat at 8:30 a.m. ET?
It's all about the December Consumer Price Index. The street consensus is holding out for 2.7% year over year.
That's the number they need to keep the Goldilocks narrative alive.
Precisely. That sweet spot where the Fed can feel confident. But the soft expectations are sitting a bit lower, maybe 2.4% to 2.6%. If we print above 2.7%, that story breaks.
And it breaks before the opening bell even rings.
Instantly. It guarantees an immediate liquidity shock.
And then you have these two major political overlays compounding the risk. This injects a whole new premium into the pricing model.
It does. First, you have the political threat from Washington. President Trump's proposed 10% credit card rate cap.
That's not just background noise.
No, absolutely not. That one piece of potential legislation rewrites the entire playbook for the financial sector. It just attacks the core of their high-margin interest income.
And then the second piece, which is really unprecedented, this Fed independence risk premium. It's stemming from the DOJ's criminal subpoena for Chair Powell. Why does the legal headline translate so fast into futures pricing?
It's all about discount rates and certainty. The market has to trust the Fed's independent discretion for monetary policy to work.
And a criminal probe shatters that trust.
It introduces political uncertainty right into the central bank's engine room, so the market reacts. It demands a higher return for holding long-dated bonds because the risk of policy becoming compromised has just shot up.
And that uncertainty pushes the 10-year yield higher.
Which is, as we'll get into, absolute kryptonite for growth stocks.
So a crucial inflation read, major bank earnings kicking off, and a criminal probe into the Fed chair, all colliding. Where is the smart money flowing to hedge this?
Well, what's fascinating is the defensive rotation you can already see. While the broader indices are pinned, the financial sector, the XLF, is acting as the primary liquidity magnet pre-market.
So money is flowing out of pure growth and into value and cyclical names.
Exactly. It suggests the big players are hedging against sticky inflation. They're positioning for banks to show resilient net interest income guidance, sort of decoupling them from a potentially hot CPI.
Okay, let's hit the tickers driving that. Starting with the heavyweight, JPMorgan, JPM. They kick off earnings. A Q4 beat is pretty much priced in, right?
Yeah.
The focus is all on 2026 net interest income guidance.
Right. NII is the whole game now. It's the difference between what a bank earns on assets, loans and mortgages, and what it pays out on deposits.
And in this higher rate environment, NII has been turbocharged.
It's the stable, predictable revenue stream. So Jamie Dimon's guidance today is the barometer for the entire sector. He has to project strong NII growth while at the same time explaining how they'll navigate the threat from that proposed 10% credit card cap.
That cap is a direct hit. So if Dimon sounds cautious, the whole sector could sink, even with strong numbers.
That's it. The credibility of his policy response is just as important as the numbers. For JPM, the bull case is twofold. They need to raise that 2026 NII outlook and give convincing commentary that the rate cap threat is manageable.
And what's the level to watch for that confirmation?
We need to see clear buying volume pushing it above $258. That's the threshold where institutional FOMO kicks in, confirming that policy threat is discounted.
But if that guidance disappoints, the bear case is a fast slide.
Takes us straight down to $244.50. And if we lose that level, it triggers a retest of the 50-day moving average. Failure there means the policy risk is officially priced in.
And we are seeing that policy risk in Capital One COF already.
Oh, they're the poster child for it. Shares are under heavy pressure because investors are explicitly pricing in the Trump cap. It's a pure regulatory short right now.
Okay, let's shift gears to the momentum trade. The reason the Nasdaq is holding up relatively well, Alphabet, GOGLL.
Yes, officially in the $4 trillion club. And the momentum is almost entirely driven by that confirmed Apple Gemini integration for Siri.
It's hard to overstate that deal. It's basically free advertising and distribution baked into every Apple device on the planet.
And it connects directly to the infrastructure trade that's booming. Which brings us to Vistra Corp, VST.
A textbook gap and go setup this morning, gapping up over 10% pre-market.
All because they locked in a 20-year power purchase agreement, a PPA, with Meta Platforms to power new AI data centers.
So why does a 20-year PPA cause a 10% jump like that?
It's the long-term visibility. A 20-year PPA is essentially a massive, high-margin, inflation-adjusted annuity. It completely de-risks VST's balance sheet. It tells the market that AI's demand for electricity isn't a fad. It's a structural, decades-long trend.
So for VST, where did the profit taker step in?
If it can clear its current pre-market resistance, the bull case is a run to $178. That's blue sky territory, pure momentum. But if we see profit-taking on this move, the key support is $162.
The gap fill support zone.
Exactly. Buyers have to show up there. If we lose $162, the narrative breaks. It suggests the move was just headline-driven.
And quickly, Delta Airlines, DAL, also reporting. What are you looking for there?
I'm looking for two signs of stress. First is revenge travel fatigue finally kicking in. And second, margin pressure. Are elevated fuel prices starting to really compress margins again?
A strong guide could spark a short squeeze up towards $68.50.
Right, for sure. But if the CEO hints that consumer spending is softening, the bear case is a slide back to support at $61. DAL is a perfect thermometer for the health of the consumer.
Okay, let's zoom out. Let's establish the technical line in the sand for the major indices. We need a clear strategy for the bell. Let's start with S&P 500 futures, the ES.
Yes, let's do a tactical review. Traders need clear boundaries today to separate the noise from the actual trend.
The pivotal level for the S&P 500 today, our line in the sand, is 6,975.
And what does holding that level create for the market structure?
Above 6,975, the bulls are in control. They'll immediately target the psychological 7,000 handle. And a clean, high-volume break there post-CPI invites a rapid FOMO melt-up towards 7,045.
But if the print is hot, or if JPM's guidance is weak?
A failure to hold 6,975 signals a failed breakout. That puts us back on the defensive, targeting Monday's base at 6,925. The directive is critical here. Do not chase 7,000 until that 8:30 a.m. print is fully digested. The risk-reward is just not there.
Very prudent. Now, the Nasdaq 100, the NQ, it's a different animal because of its sensitivity to rates.
It is. The line in the sand for the NQ is 23,750. Above that, we target 24,050, driven almost entirely by AI optimism. That's the consensus trade.
But the trap is on the downside.
Exactly. If we lose 23,750, technical exhaustion will kick in fast. Initial support is 23,500. But the real deeper liquidity trap zone sits down at 23,200.
And you have to understand, the NQ is extremely sensitive to the 10-year yield. If that yield spikes on a hot CPI, tech will be the funding source for the market rotation.
Which brings us right to the macro dashboard. Let's look at the U.S. 10-year yield, holding firm at 4.20%. This is a structural pivot, isn't it?
It absolutely is. The move above 4.20% is a fundamental shift. And what's crucial is that the recent spike from 4.12% isn't just inflation fear. A large part of it is that new political risk premium from the Powell probe.
So if the risk-free rate is climbing, what's the immediate implication for those high-flying AI names?
It's a significant headwind. I mean, tech stocks are a duration play. They rely on the value of distant future earnings. When the risk-free rate climbs, the discount rate used in valuation models goes up, and the value of those future earnings shrinks.
So a move toward 4.25% on the 10-year puts a brick wall in front of the whole multiple expansion story.
A solid brick wall. Their balance sheets become inherently less valuable.
And we also have to look at the U.S. dollar index, the DXY. Consolidating near 99.00.
Right. Retail often overlooks the DXY, but it's showing a constructive short-term uptrend. And you have to ask yourself, if the dollar strengthens, what does that mean for companies earning most of their revenue overseas?
It's an earnings killer.
It's an earnings killer. For giants like Apple, Microsoft, the AI hyperscalers, every tick up in the DXY is a direct haircut to repatriated margins. It's this invisible drag on big tech valuations.
Let's pull this all together and talk about the pain trade, the one that retail seems to be missing while they obsess over short-term Fed cuts.
Yeah, retail is completely focused on the front end of the curve, the Fed funds rate. They assume any talk of rate cuts is an automatic bullish signal for tech.
But they're missing the forest for the trees. The real risk is the dreaded bear steepener. Can you explain that trap?
Okay, think of it this way. The Fed throws you a life raft. That's the short-term rate cut. And retail grabs the life raft and cheers. But at the same time, the ocean floor, which is the long-term discount rate, is moving up. The 10-year yield is spiking higher because the market fears the Fed is losing control of inflation or, critically, losing its political independence.
So the trap is set. Retail piles into the Nasdaq because of the rate cut headline, but the discount rate, the 10-year, moves violently up against them.
That is the exact mechanism of the bear steepener. And the result is a kind of stagflation light. Your favorite AI stocks trade sideways or down, not because their earnings are bad, but because their capital value is being destroyed by a rising discount rate.
Which is why we have to watch that 4.25% level on the 10-year like a hawk today.
If we break that, the dip buyers in tech are going to get caught in a serious liquidity trap.
So our overall market verdict for this morning is a potential liquidity trap. We're at record highs, but the volume is concentrated in just a few mega caps. These headline risks could provide the flush that wipes out the late entry bulls.
To confirm a true breakout above S&P 7,000, you need a very specific combo. You need a cool CPI print, ideally in that 2.4 to 2.6% range, and you need strong, convincing guidance from JPM that navigates that rate cap risk. Absent that specific combo, you have to stay cautious.
Okay, let's synthesize the actionable watch points for the open post-CPI, 2 critical levels to focus on.
Number 1, 6,975 on the S&P. That's the point of no return. If we don't hold that level 15 minutes after the print, the trap is sprung. We are likely heading for Monday's recovery base.
And number 2, the 5X. If it stays below 15 post-CPI, sentiment probably tilts bullish on a no-surprise read. But if it spikes above 16, expect a hard rejection of the highs as institutional hedging kicks in.
Exactly. This market demands discipline, not heroics. And here's the final thought for you. If the 10-year yield breaks 4.25% today, how quickly does institutional money rotate out of AI dominance and back into tangible, high NII financials, effectively deciding that the rising cost of capital outweighs the threat of the rate cap? That rotation velocity will define the market for the rest of this week. Stay nimble. The bell is ringing.